So you're searching around and you're trying to figure out, well, how does whole life insurance work, right? And how is it different from maybe other types of life insurance? Is it different than, say, what I have at work or something that, I've heard on the radio, term insurance, universal life? What are the differences? We're going to get into that today, and you're going to have a real good understanding of what a whole life insurance policy is and how it works and all the different components of it by the end of this video. First, let's just talk about a couple of differences, right? Whole life insurance is a type of life insurance that is meant to be there for your whole life, hence the name, right? This is different than term insurance, which tends to be temporary because it's set up for a certain period of time. Term insurance might be 10 years, 15 years, maybe even 30 years, but not much past that. And while term insurance is a cheap out-of-pocket premium today, the need for insurance later on in life means that you have to get reevaluated medically, re-underwritten. You have to be able to qualify, and we don't know what we're going to look like in the future as far as from a health perspective, so it may be more difficult and much more costly to buy insurance later in life. Using whole life, you're building in that protection now. You're guaranteeing your premium and you're guaranteeing your death benefit. Two components that are synonymous with whole life is that guaranteed premium. What's that mean? Well, a guaranteed premium means that once it's set, that monthly payment that you're making to that insurance policy will never change. It's guaranteed and set for the life of the contract. The next part of that guaranteed death benefit, means that death benefit is always going to be the same as long as you're paying your premium. But so far, we've just talked about death benefit. So you're thinking, all right, well, whole life's going to be more expensive because it's there forever. So I have to pay more money. The death benefit is going to be guaranteed. The premium's guaranteed. But what if I just rolled the dice and had term insurance? Well, you could do that. But the other component that's not always talked about with whole life is there's a savings component to this policy. So what does that mean? There's cash value that builds up inside of this policy, and those cash values have a guaranteed growth rate that's set by the contract. So not only are you paying in premiums, but you're also building cash value, which down the road can not just build the cash value, but also increase the death benefit without changing your premium dollars. So imagine this, you're buying a $500,000 death benefit today, but 30 years down the road, maybe that's grown over time to, $750,000 death benefit or more. The policy has increased cash value inside of it that you actually have access to. And on top of it, if you're working with a mutual insurance company that pays dividends, the dividends generally get reinvested into these policies to help accelerate the growth even more. So not only do you have a guaranteed growth component, but you also have a dividend that can be paid on top of that. The components that make up the dividend, really what you're getting when you get that dividend from the insurance company is a return of profit, right? Because it's a mutual company, as a policy holder, you are able to participate, and you're a holder in that company, so you get to participate in the dividends or the profits of that insurance company. What that means is that if the insurance company has good investment results, right, because they're taking money in and they're investing that money for the future, if they also have mortality claims lower than what they expected, well, what's a mortality claim? Every time you buy an insurance policy, it's underwritten by the insurance carrier. Underwriters look at you from a health perspective and they say, okay, where does this person fit on our risk profile? And that's how they price how much you pay for the insurance. So imagine it's not just your underwriting that's done, but every single policy that the insurance company sells has been underwritten. And they have an expected mortality. They know from actuarial science how many people they expect to have to pay a claim to. If they do better than expected, meaning there were less claims in a given year than they were expecting, well, that means that there's some return of profit because they were profitable and made extra money. The other component that's in the dividend is the expenses. So as expenses of the company are paid out, if they can reduce expenses or keep expenses low, that also helps to maintain profitability. So like any other company, they're projecting things out into the future. That's where that dividend rate is coming from. So you get to participate in a company that is paying dividends. And what does that look like? Well, some of these companies, mutual life insurance companies, have been paying dividends since the 1800s, 1869, 1850s, a very long time and a very strong track record. So that's really something that you should think about if you're going to purchase a whole life insurance policy. If you're enjoying this content, go ahead and hit the like button. We're putting new stuff out like this every single day. And in your search for more information on whole life insurance, check out this video right here.